morning, traders. Mark Heath here from Flipside Trading. It is Sunday, May 3rd, and here we are coming at you with another edition of On the Brink. We want to talk about the case for chop as the market is really in a conflict between its major and minor trends, and we want to see potentially how it may resolve itself and what are the key decision points that will tell us which way the market is going to be moving. So to do that, we need to go ahead and take a quick look again at trend and understand what trend is and what it means, as that'll have a key effect when we look at the charts. So, as we know, the market itself moves basically in a stair-step pattern, and we get up, a higher high in this case, higher low, higher high, and higher low. And that's because the market is driven by humans, and there's different points and different information, and everyone assimilates that information differently. And in a lot of cases, regardless if you're bullish or bearish, things get carried over to a little bit of exuberance, because even though the market is an efficient, I'll say, arbiter of price and discount on information, it doesn't happen immediately, right? It takes time, right? There's kind of like you're carrying a tray of water, and you stop and it sloshes over to one side, and so we run up and then we run down, but the overall trend is kind of this reversion to the mean in the middle. So it's really important to understand that we have these higher highs and higher lows, and you can see that down here in more of a graphical fashion. And the key thing is when does this trend change? Well, the trend changes, and in this case, if we stopped right here and made a lower low, okay, we potentially now are on the alert for a trend change. But until it breaks this active low, the trend does not change. So if it came back here and moved up, the trend would still be intact. It was just a consolidation. So we're going to be looking at trend in that context to really examine where the market is from both a long-term and a short-term perspective and what it may do. So let's look at the technicals, and with the idea of trend as context, I think we'll get a really good idea of what's happening. So let's take a look. So right here, if we look at the weekly chart, we've definitely broken the lower lows, right? So we have a potential, right, for a downtrend. Now I'm saying that is because, look, we've made a bounce, but we haven't come back down and made another lower low. Now that is possible. Or what could happen is, right, you can come down to a support perspective and then bounce back up, and this trend would continue moving forward. So to make that determination of which way we're going to go, right, this juncture point potentially here, we need to go and look at the lower time frame chart, and that's the daily. So looking at the daily right away, we can see that, potentially we've broken this trend line, but we haven't really reset ourselves on trend, because here is the last active low, right? We would have to break this low, have a lower high, and then a lower low to say that trend is reversed. And if we do get that, that indicates, if we go back to the weekly chart, that we are probably headed lower. But if not, right, if we come down here, make a higher low, we still have this scenario, and that's where we can move to on this case. Look, I can't predict exactly where the market's going to go. I don't have a crystal ball, right? But I can show you where the decision points are, so you can make intelligent decisions on what's going to happen. Now, if we take a look at, let me clear some of this out here a second. If we think about trend for a minute, right, the market tends to move symmetrically. So if we look at the pullbacks, this pullback and this pullback, and we project it from here, as long as these pullbacks stay above this level here, then we are more likely to be on this scenario. The reason we may continue down a little further is because we can see here on the weekly chart, right, we have this huge topping, bearish candle, right? Price was rejected and got pushed all the way down. So it would make sense to see price come down a little further before moving up, all right? Now, if it goes all the way through, then we look more for the bearish bias. So let's take a look at this in a more detailed perspective instead of eyeballing it, and show you how you can use your Fibonacci tools to see whether or not we've broken this lower low or have the ability to break this lower low based on the symmetrical pattern that we see here. So let's get rid of this. And the first thing we do, we're going to go ahead and plant our cursor here, and we're going to go to add a drawing, and we're going to go to our Fib extension tools. And we're going to go from, oh boy, I love the way this does this all the time. So let's get rid of that. All right, we're going to go right from here, and we have to go add the drawing, Fib tools, go right from here, and we'll go up. And we can see that the 100% retracement, all right, still keeps us above this level right here. You can see even the 127 is probably just below that. So now let's take a look at the second pullback. All right, we'll take a look at the second pullback for the Fibonacci perspective. We'll put it right here. We're going to go add a drawing, Fib extension tools. We pull it down, pull this back up. And now we'll go ahead and take a look at this in a little bit of detail. And we see that the 100% in both cases has kept us above this point. So the initial feeling is that from a bias perspective, based on the weekly candle, I would expect us to drop 1 or 2 days beginning next week. And then if we're going to go ahead and make a bounce back up and hold this active low and keep the trend intact, then once we get to this 100% level, which is right around the 21 EMA, I would expect to see the market move back up. If the market breaks this, then I think that we're in for a much longer downtrend coming forward. So if we take a look at the other indices really quick, we'll be able to see that as well. So let's go back over here to look at the NASDAQ, right? NASDAQ, same thing, right? Longer trend says we're down, we're coming back up, but hey, can we pull back and continue? Absolutely, right? Do we have these same type of pullbacks? Yes, we do. If we look at the symmetry of those pullbacks, and we're just going to eyeball it here, but you can see that this pullback and this pullback are only going to bring you about, to this far, which is above that last active low and kind of coincides with the 50-day moving average. So again, right, we have a bearish candle that provides the impetus to go down probably this level to maintain this intact. If we break this, then all bets are off, right? Then we need to change our disposition and say, hey, we need to be more on the bearish bias long term going forward. And of course, the same thing we could see with the Russell. And the Russell is showing us, look, okay, here we are in the weekly chart. Again, we have our big leg down. We're trying to decide. You can see we're in this channel. This channel hit the top. It moved us down for a slightly bearish bias. You can move this bearish bias, down to this level. If it does bring us this level, it has not broken the overall minor trend, during the day. And again, if we look at those pullbacks, that it would show us basically the same thing, right? We take a look at these pullbacks here and these pullbacks, and look at the length of that line. It pulls you right about, right about to here. So all three indexes are telling us the same thing, that we're in this decision whether or not the major trend is going to continue, okay, and that's based on the weekly, or if this minor trend we have in the daily is going to help us move forward. Now we have some decision points, and the reason that we really don't know is because there's some fundamental factors that we need to look at as well, right? We like to look at the market from a technical standpoint. We'll take a look at it here from a more fundamental, broader perspective in just a second. So let's do that by looking at some of our key charts and see if they're telling us the same thing. So remember, this is our dashboard. Here's our advanced decline. And we said, hey, if we broke out of this Keltner channel, that would be a bullish signal. Well, we didn't break out for the week. We actually came back in, which is exactly what the markets did. Okay? So it's telling us, hey, again, we're at kind of that decision point. Same thing here, right? Our advanced decline, we broke the 50, but we started moving back down. So if we hook back up, then that tells us that minor trend is definitely in play and that the market is going to move higher. So now we're in a wait and see mechanism to see whether or not we get that inflection standpoint. I'm just going to look at two or three more here. The key thing here is, look, we're up above. We broke on the 50. This is the ratio of breadth, right? How many stocks are above the 50 EMA and how many are below the 200? We're still well below the 200, and our on-balance volume hasn't triggered yet. Again, it's telling us we're kind of a little bit in no man's land. Go back to the VIX. Now look at the VIX here. And remember we talked about trend, right? So we have this, right? We had basically a higher high, and now we've come back and made a lower low, which tells us that we're in consolidation because we don't have either on the trend. So now we're going to wait and see, really what we're going to do here and break. And if regardless we stay, in this range, I think that, you can see this move up. As long as we can move up, we haven't broken this, we can still move back down and maintain that trend. Now this is saying, like we looked at before, right? We had those bearish candles in all three indexes on the weeklies. We also showed that the symmetry levels, definitely look like they would pull back before they would push up. So I would see the VIX, right? I wouldn't be surprised to see it move up before it moved back down moving forward. And lastly, let's go ahead and clear these. We look at risk on, risk off based on our bonds. Remember, the bond market is so much bigger than the stock market, and usually people consider it a little bit more intelligent because that is not where your retail investor hangs out, right? This is where your big institutional money, hangs in. And you can see, right here that we've, made this higher high, we have a higher low, and so now the question is, do we bounce back up to a higher high? But right now, we're in a potential coming down here for a lower low, and this would be definitely risk off. So again, we have to wait and see and tell us what the market is going to do. So overall, we've looked at it from a technical standpoint, and all these different charts that we've looked at, not only the indexes themselves, but let's call them the indicators, the internals of the indexes, have all told us the same thing. So I think that our decision points as far as trend is concerned is pretty clear. In the short term, we're really looking for more or less a pullback, right? And then the question is, what's the level of that, or the magnitude of that? If it's a certain magnitude, right, it stays above the last active low, then we're going to go higher. If it breaks it, then we have to start looking at a more bearish bias. So the key thing is the market is always moving on information. So we need to go back and think about where we are from an information perspective that's going to change the sentiment of the market of what we're looking at. So if we look at this, we have some opposing forces. From a fundamental economic standpoint, what's moving the market up? Well, the economy is beginning to reopen, and that's definitely positive. And you can see that, as the economy reopens, and then people start earning money, people can spend money, and the economy starts to potentially start to grow. Our unemployment seems to be stabilizing. You can see down here is that the number of unemployment claims is starting to slow down, right? We are at 30 million. Okay, that puts our unemployment rate at 18.4%. Okay, 30 million people unemployed. That is definitely going to pull the market down for a while because there's a longer lasting effect. We'll talk about that in a second. But overall, you can see the market saying, okay, we need to take a step back here, and there is hope in the future. There's a promise kind of a recovery, right? It's not a vaccine, it's not preventive, but overall kind of a rehabilitation appeasement piece as far as the drug, remdesivir, which is produced by Gilead, okay? That has got approved by the FDA on emergency fast track to start being used in treatment. If we see this really take traction and really take hold, well, again, that's promising for the economy as people are getting back to work and that our health risk has been minimized. the Fed is still printing money, right? We talked about the $6 or $7 trillion. Congress is still looking at their overall, I say, additional plans to support the market. And as long as that we have that safety net of the Fed printing money, at least in the short term, let's not talk about what it means from a debt and a productivity perspective long term, but it should hold a floor to the market. And lastly, from the global standpoint, the European Central Bank and the Bank of Japan are also going all out and pulling out the relative stops and adding to this kind of global safety net in the form of printing money and creating liquidity. Now let's take a look at some of the key things that are really pushing the market down. And number one, right here, we have to look at the U.S.-China tensions. Look, the United States, there's a political game going on here as well. I'm not going to get into the politics of it too much, but basically our president is trying to deflect some of these things and really paint China as the cause for this whole epidemic and therefore its impact on the United States economy. Whether you believe that or not, it doesn't matter. All right? What we want to talk about is what the market believes from that. So Trump is saying, okay, hey, number one, we're going to start attacking China economically. And we're looking at that in three different phases. China is one of the largest bondholders, second only to Japan, of U.S. Treasuries. And there's, I should say, legislation and discussions afoot that we are no longer going to pay the interest on the debt that they hold. So the interest on $1 trillion worth of debt is significant, right? So that would definitely put a crimp in China's economy. In addition, there's talk about suing China and actually requesting reparations, quote unquote, that the virus was created there, born there, and that there are a bunch of misleading statements, and therefore they're liable. Now, China doesn't apply to the rule of law like the United States does. So that actually happening is probably zero, but it does weigh on the overall markets. The next thing is Trump is talking about additional tariffs. Again, we know what a tariff war can do to the United States economy. You've seen it from the stock market where it goes up and down based on if we have a trade deal or not. If we have a trade deal, the stock market moved up, and if not, it moved down. And it moved down because the overall price of goods were higher to the United States, and if the price of goods is higher to the United States and to our consumers, given this stage of unemployment and our overall debt levels and overall income levels, that is going to put a crimp on the economy. And lastly, there's the U.S. pension fund restrictions. Right now, the federal employment, or say the federal workers' employment pension fund, is invested in China securities, and it's allowed to do that. Now, if we pull that back, that's $50 billion that gets pulled out, and that'll not only hurt China because there's no more capital investment, but it also has a worldwide shock because the indexes, which are based on some of those China outflows and inflows of capital, now have to be totally rebalanced, and the market doesn't like uncertainty in that rebalancing. We have to look at what's happened based on the impact of the coronavirus. We have a new world, we have a new model, and a new cost. So what does that mean? So it means a couple things. Let's look at Amazon, right? Amazon earnings, they just killed it, right? They had $4 billion of earnings in this last quarter. Everyone is buying from Amazon because they don't want to go to stores, and it's convenient, and also they have a supply chain that's providing people what they need. Well, the deal is that in order to make that work and achieve that revenue, Amazon had to hire 175,000 people. They have to change their overall working conditions, and it changes the overall efficiency. And so basically that $4 billion was spent, creating a new model just to survive. So the earnings per share came out to be zero. So the costs of operating in this new world are much, much higher. And Amazon has definitely proved that. And I think that you're going to see that even down to the service business, right? If a restaurant opens at 50%, you now have to have, you have to take extra time to wipe and disinfect tables. You have to do different things on credit card swiping. You may ask people to sanitize their hands before and after they come into the restaurant. All these things are new processes, new overhead, which will add additional costs and weigh on the bottom line of all these businesses. Consumer sentiment. We can see that consumer sentiment, because of everything that's happening, is very, very low. It's dropped to basically the lowest it's been in the past 6 or 7 years. And one of the things that's happening is that people, these S&P 500 companies, as they report, and we've had 2/3 of them report already, they're already saying that when we reopen, we are not hiring everyone back, right? We're going to trim our workforce by 10, 15, 20% in order to be leaner, because we think demand is going to be smaller. And so these people aren't going to be rehired right away. And so as the economy reopens, it's going to reopen slower. And lastly, we want to talk about the Fed, right? The Fed, we're on a bond buying reduction, and the Fed is actually, so we're not putting as much money in. Let's just call it a semi-operational basis. But we've also, kind of went from a bazooka to a sniper, right? The bazooka was, hey, we're going to do something we've never done before. We're going to put $4 trillion into the market, and we're going to buy corporate bonds. And not only that, we're going to buy high yield bonds as well, right? Well, they've kind of moved away from that as far as making these big announcements, and they're kind of serving as a sniper. And these snipers are, well, we're going to give $25 billion to Boeing because we feel that they're too big to fail. We're going to give another credit infusion to Royal Caribbean and from a cruise line. And so the Fed is kind of picking and choosing, and we've gone from kind of capitalism to basically social corporate socialism. And you just don't know where the Fed is going to react. But overall, the Fed is kind of in a wait-and-see policy. So I think the key thing here is what you're seeing is that overall there's a little bit bigger propensity right now on this side for the market to kind of dip back a little bit, at least in the short term, until we see some additional news on this side, and it's just going to take time. And as it takes time, that's why we're going to see the market shop. So does that really change where we're going as far as value and growth? The answer is no. I think as far as we look at the overall economy that we've talked about, the new corona economy, and we take a look at where growth is, and this is representation of growth stocks. 1 second here. We always have this. There we go. We can delete all that. And if you look at growth, we can see that growth has cranked, right? It's moved, and this is really representative of the market. Looks a lot like the Nasdaq, and it's reached this 200-day moving average, and it's kind of pulled back a little bit. And you can see that value has kind of done the same thing. And I'll take this off and we'll look at value. Value. Here it is. All right, value has moved up as high, but it's also pulled back. And the key thing here is both growth and value have pulled back, but both can still be on our overall trend move, right? We can still move up here because we have not broken the lower low. Okay, that's the same thing with growth. You dog, you. Come on now. Right? We have this momentum coming down. We can see that happening. As long as we don't break this level, we can come down here and keep that minor trend still intact. Okay, guys, that's all I have. I think to maintain, I'd move some stops up at this point in time. That's what I've done. Also taken a little bit of profits, from longer term portfolios. I would definitely consider positioning myself short for the beginning of the week or so. Look at the key inflection points to see where trend is going to be. This is what I'm going to do. This is not investment advice for you. This is purely educational standpoint, but as you can see that you have those key decision points. They're very clear on what we need to look at and determine what the market's going to do. Don't guess, right? Do not say, I believe the market should do this, the market should do that. Let the market tell you, let it confirm. based on the technicals that we have laid out here in our two different scenarios. All right, gang, have a great one. Catch you on the flip side. Take care.